You're listening to Criticaleye's Inspiring Leaders podcast. Criticaleye is a global membership community with over 2 decades of experience supporting senior executives in their roles. We work with board-level executives, giving them opportunities to build their knowledge, skills, and access independent reference points outside of their immediate networks. Whether you're stepping up into a more senior role or aspiring to do so, looking to hone high-level stakeholder relationships, drive operational performance, build your own personal resilience as a leader, or have longer-term career goals such as moving into a plural career, Criticaleye's approach supports a range of leadership challenges and ambitions.
Hi there, and welcome to Criticaleye's Inspiring Leaders podcast. My name is Jacob Ambrose Willson. I'm a senior editor at Criticaleye, and I'm your host for this episode, looking at what's in store for the private equity market in 2026. And to do this, I've enlisted the help of Alastair Mills, who is Managing Director and Head of European Business Services at H.I.G Capital. So H.I.G is a global private equity firm that invests in small to mid-sized companies through various funds and focuses on buyouts, growth capital, and special situations. Alastair has been at H.I.G for over 15 years and in total boasts over 25 years of experience in PE. So I think it's fair to say that he's the right person for the job when it comes to assessing the market in 2026. Okay, so thanks for joining me, Alastair, and a very happy new year to you.
Happy New Year.
Perfect. Okay, so I wanted to start by looking back at last year and how you would summarize the PE market in 2025. I suppose were the activity levels broadly where you thought they would be across the market?
Yeah, so let's start by quickly looking backwards then. 2025 was a tough year. If you look at the stats, volumes, which I think are always a better metric than values, because values tend to be so skewed by a few very large deals, which don't necessarily repeat on an annual basis. But volumes are volumes. Volumes were down a lot on 24, and 24 wasn't a particularly buoyant year compared to some of the years pre-COVID, but volumes were down something like 20% over the period. Now that data I'm caveating this slightly because that data is only to the end of Q3 because we haven't had the latest data yet. But directionally, it's not going to have been that much different. I wouldn't have thought. Now there are some differences in the different markets within that. It's not uniform across different sizes of deals, I would say. But as a broad brush comment, 2025 was a tough year from a volume perspective, definitely down on value because there weren't so many of the very big deals announced in 2025. Doesn't necessarily mean 2026 is going to be the same though. So we can obviously explore that in a minute if
Yeah, and just to maybe look at some of the drivers for that decrease in volumes, and in terms of headwinds, obviously the Trump tariff saga will have had some effect on deal making last year. But with the benefit now of some time for things to settle, can you sort of say how impactful the tariffs have been on volumes and the PE market going forward as well?
I think it's really difficult to disaggregate one thing.
Hmm.
I guess that's probably the first statement. So every year, you can go back every year in history, a lot happens, full stop. However, it does feel as though there was an abnormal number of almost black swan type events that happened in 25 versus perhaps whatever an average year might look like. So tariffs, yeah, it was definitely one feature. Had the tariffs not been there, would that have helped? Yes, it creates friction, which wasn't previously there. It was previously there to a much lower level because obviously tariffs existed. They were just generally set at much lower levels. But if you look at like the multitude of factors that investors generally have had to deal with, you're looking at generally poor Western European economic performance. You're looking at this sort of the rise of AI that's really come out of nowhere, at least in terms of the non-tech world consciousness over the last 12 to 18 months.
Yeah.
Inflation itself hasn't gone away. Obviously, that was a bigger issue perhaps 2 or 3 years ago, but it hasn't gone away. There's always been a concern that we haven't totally gotten control of things. Governments in the Western world generally have fewer levers to play with. Obviously, the US is in a slightly different spot there, being the reserve currency. But if you look at the European economies, the ability to be able to sort of print money and spend to get out of a problem isn't there to the same extent that it was in the past, perhaps with the exception of Germany, the major European economy. So there's not like lots of positive elements for investors really to get their hands round. That said, there obviously is a requirement on the private equity industry to invest. And there's a requirement on the private equity industry to obviously churn portfolio companies. That's the purpose of private equity, to generate return for investors. And private equity as an industry hasn't been doing enough of either of those over the last few years. And that's why, I guess, just the if you want to call it the weight of money, it should drive more activity in 26 than we've seen in 25, maybe more than 24. I obviously I don't know, but my sense is that we're starting from a low base, short of another big unpredictable event happening.
Yes, yes. If we quickly look at the UK, and of course, all eyes were on the budget statement towards the end of last year, including obviously those working in PE. So, what was in there in terms of any tax changes relating to the sector, either directly or indirectly?
I think this budget was much more muted in terms of its impact than the previous one. So we've really been dealing with the tail effects of the previous budget and continue to deal with those. With that's employers, NI, the rises of capital gains tax rates, the removal of non-dom status for those people that were previously sort of beneficiaries of that, and other factors. That just all has a sort of incremental, acts as a sort of incremental creep, a potential incremental break on particularly the private equity industry. I think if I look at this budget specifically, it's obviously more limited in terms of the specific elements that draw directly or impact directly on private equity. But the fact that obviously income tax rates or the thresholds were frozen will have a drag by virtue of the consumer having less pounds in their pocket, which will have an impact throughout the economy. So it's not as if the fact that there weren't specific changes that had more of a targeted impact on private equity will mean that there will be no impact on the industry. You know, there will, but there will be impact across the economy as a result of this. And I think, I guess the challenge is one of what investors generally believe, you know, the government's sort of agenda is in terms of its sort of support for business. And there are some initiatives that are there to support growth companies in particular, some initiatives around enterprise investment and VCT, so very much targeted at growth companies. The problem is perception, and I think the perception, rightly or wrongly, is that there isn't enough support for business. It's not that the government, I wouldn't say is anti-business, but it's definitely not prioritizing business and growth in the way that was perhaps anticipated when they came in, based on the rhetoric leading up to the election.
Yeah, yeah. Okay, thank you. Maybe we can delve into some trends in the space at the moment. We've been hearing a lot lately about the use of continuation funds by private equity houses. Why has this become more common, and do you expect that to continue that trend into this year?
It's become more common because there haven't been sufficient exit routes at the right sorts of valuations for private equity investors.
Hmm.
And so where there's a challenge, an investor challenge, then smart people think of solutions. And what one solution is effectively to lift assets or groups of assets out of existing funds and set up effectively another fund with a smaller group of investors that then buy that asset out
Hmm.
an agreed valuation. So that generates a return for the first fund, the selling fund, and obviously creates an investment opportunity for the investors in the continuation vehicles. So it does provide an exit solution.
Yeah.
The problem with it is that as a private equity investor, you ultimately are looking to raise, or most private equity funds are funds, and they're dependent on investors committing to those funds, and investors commit to those funds really on the basis of the quality of the investments you make and the returns that you are delivering. And part of that is measuring the nature of the exits you're able to achieve. And so whilst a continuation fund exit is still an exit, you've still generated a return, you've still returned cash to LPs. My personal view is that it will be part of the toolkit rather than the majority of the toolkit going forward. And the reason for that is that I think that funds that lean on the continuation vehicle products too much as a solution will find it that little bit harder to raise the next fund, all things being equal, because people will question the quality of the assets if you're not achieving enough exits to trade to other private equity firms through IPOs, etc. You're leaning more
Yeah.
on continuation vehicles, where obviously you continue to manage that asset. You've just had a change of LPs in effect.
Yeah, yeah, it's interesting because I wanted to ask whether you see continuation vehicles as a solution to a kind of short-term issue in the industry, or whether it's part of a long-term shift in how PE funds hold and exit their investments.
I think it's somewhere in between. So as I
Yeah.
said, I think it will be part of. It'll just be another option that's
Yeah.
available going forward. But I think people will ultimately become a bit more wary about leaning on it too heavily. I also think in the relatively short time these things have been used quite widely, the investors that support those continuation vehicles have become a lot more savvy.
Yeah.
So potentially moved from we are the solution for very long hold assets that you're otherwise struggling to sell, i.e., should they be investing in them in the first place, to actually the continuation vehicles wanting to focus on actually the better quality assets and investing in those when you're in year 3 or 4, and providing the GP, the private equity manager of the funds, with the
Hmm.
capacity to manage them for another 3 or 4 years. So maybe get eight years of backing behind a winning horse as opposed to exiting after, say, year 4 or 5. I think that's where more of the CV focus has been going, and will probably continue to go. That's a much more underwritable case for the investors in those CV vehicles.
Yeah. Yeah. Okay, so coming now to the year ahead, 2026. What's your sense on how the industry will fare from a deal volumes perspective? Now, you've already mentioned, there should be a lift because we're coming off a low base. But could there be a bit of a perfect storm if interest rates are to come down, combine that with already lots of dry powder in PE?
I don't know about perfect storm, but I think there is the potential for life to be somewhat better.
Hmm.
There are a lot of large sell side advisors who are sitting on a lot of mandates at the moment, and those mandates have been waiting for the right time, and they've been waiting for a while. And some of those will be private equity backed businesses where the clock is ticking to some extent, where there isn't
Yeah.
a continuation vehicle option, and the investor needs to generate a return. The pressure is mounting on those private equity sellers, which is a decent proportion of that sort of sell side slate. We are already seeing in, let's call it the middle market or the upper middle market, more activity where private equity sellers are perhaps being a little bit more pragmatic around their C plus B grade assets, and looking to move them on at acceptable returns rather than still believing that they can get, you know, the A plus valuation for those assets, and therefore choosing to hold on. I'm not sure, and I'm generalizing massively, but I'm not sure it's fully trickling down. It definitely hadn't trickled down into the lower middle market space, i.e. the sub 30 or 40 million EBITDA market environment in 2025, but had started to happen in 2025 at that upper strata, let's say that sort of 30 to 80 million EBITDA range. And therefore there has been opportunity for those funds that are prepared to take a little bit more of a risk on those sort of C plus, you know, B grade assets, because there's been perhaps a little bit less competition for those, but there've been more willing sellers. I think we'll see a bit more of an element of that. I think people will still be reasonably risk averse, but the pressure of needing to deploy will encourage people to take a little bit more risk than they did in 2025, is my own view. The curveball in all of this is that there are things that are quite difficult to assess, like AI, for example, that will have an impact on a lot of different businesses and business models and potential future valuations in ways that are really difficult to predict in a lot of cases. And to the extent people are prepared to take a view on that, will be interesting.
Yeah, no, it's certainly an interesting element of all this, and we'll get onto it. But I suppose one of the more challenging situations that we could sort of come into is whether, you know, the economy enters a recessionary sort of state, and that creates difficult conditions for businesses, and that flows through. So, is that something that you're looking out for?
Yeah, look, we invest in, generally speaking, we're investing in things or situations with some degree of complexity. So if I look at H.I.G specifically, yes, absolutely. Part of our mandate is to invest in turnaround situations. It's not the full mandate; it's a small part of the mandate. But as the economic cycle ebbs and flows, then it becomes more into focus. I think there's a possibility that it comes more into focus this year. That said, 2025 had its headwinds, so it was on the radar as in terms of a asset class of opportunity in 2025, and I think that will exist in 2026. I don't think. Look, the economy in the UK obviously isn't doing spectacularly well, although when you benchmark it against the Western European economies and the major Western European economies, the UK is not doing badly, but that's setting the bar pretty low. We need to be honest about that. Whether we dip into a technical recession, I'm not seeing anything that's going to suggest that we're suddenly going to be in a really difficult recession, but a deep recession. But then again, I'm not an economist, so I'm not the right person to comment on that. Whether we dip from a small amount of growth over a few quarters to small declines over a few quarters, I think it's more the psychological impact of just the word recession appearing in the press that has an effect on business investments, as opposed to the actual impact of the underlying economic trajectory.
Yeah. I also wanted to ask about, you know, what type of exit mix are we likely to have? You know, we talked about GP-led secondaries, there's trade sales, IPOs potentially making a comeback. Do you have any insight on the exit mix and your expectations there?
Definitely a lot less on the IPO side. It's not an area of particular focus. Obviously, we do look at and we do consider IPOs as exits for our portfolio companies, but there are others a better place to comment on the public markets than I am. statistically, throughout the last 10 years, it hasn't featured as a particularly significant exit route for us as we sort of consider exit options. For some of our larger portfolio companies, particularly those with a good growth story, good cash conversion, etc., that have performed well versus their listed peers, then it's something we've considered. But we're always aware of the fact that we're not experts at calling the IPO markets and when the window is going to be open for that, and the time obviously required is quite significant. So you need to think about whether a company's appropriate, and in most cases, if you are going to consider it, you're not considering it in isolation. You're running it as a dual track process along with a potentially a conventional sell to trade or PE. So IPO is less of a view. I think the private equity buy universe is going to be more open to buying a greater range of assets as we move into 2026 for the reasons I've mentioned earlier. Look, trade less of a view, and I think trade has been quite active. Some of that's private equity backed trade, so question mark whether that's really private equity, but trade where i.e. buyers with synergies have been relatively active, at least in terms of what we've seen, and where we've lost out on deals, they've often been to trade buyers and trade consolidators. So will there be more of that? Quite possibly.
Yeah. Okay. Let's delve into AI and the impact it's having on the sector. So, is that a reason for optimism for you? Is that a kind of tailwind for the industry, for PE houses, for businesses as well?
Yeah, it's a really pertinent question. It's a really difficult one to assess. I think if you go up to 50,000 feet and think about how you make a judgment call as you're presenting something to an investment committee, I think there's a reason why there's been a lot of interest in assets where there has been a good market consolidation story, some organic growth, but providing in most cases services that really don't, where the AI isn't a threat, it is potentially an enabler. So we've seen a lot of activity around blue collar services over the course of 2025. And I don't think it's any surprise. I don't think it's any surprise that there's more activity in areas like hard FM, like grounds maintenance, elevator maintenance, social housing repair and maintenance. I don't think there's any surprise, or there's no surprise that there's a correlation between activity in those areas and relatively limited negative impact from AI, possibly positive impact as you think about your operational efficiencies in those sorts of businesses and your scheduling of your workforce, etc., to make those businesses more efficient. And most of those businesses operate in pretty fragmented markets. So I think on that level, you're seeing a bit of a polarization away from large areas of, let's say, IT services, where I think people are really picking their fights compared to, let's say, end of 21, early 22, when most of IT services very much flavor of the month. Now there's winners and losers in that space. And as a result, people have pivoted to those where there's a much more underwritable investment committee case. So I think the really good businesses will continue to sell. Those below that, there's a much heavier AI risk / opportunity filter in terms of what people take to IC. From a private equity fund perspective, the AI obviously helps in origination. It helps identify businesses in thematic areas of interest. Definitely helps on the execution side because it allows you to crunch a lot of information. You do receive a lot of information when you're executing a deal. So starting with an IM, and obviously more latterly vendor diligence and the like. But obviously there's a huge amount of desktop research that's done as part of the process, and the ability to be able to do that and digest that really quite quickly and efficiently. AI is a game changer for that. It also allows you to work on a sort of pattern recognition basis to think about what's worked for you in the past across your portfolio company successes, and what are the patterns there, what are the features there. If you see something that comes in that has a resemblance to something you've invested in the past, what are the key exam questions that you might want to ask to sort of assess or triage it in or out relatively early on.
Yeah.
I think obviously the risk with, and it's the same with any sort of white collar professional services, that as a result of that, theoretically you need a little bit less horsepower at the more junior levels within private equity firm. The problem with that, obviously, of course, is that those junior people become the mid-level people and ultimately senior people in the organization. So if they're not there, or they're not getting the training in the same way that you had in the past by having to do the heavy lifting, what does that mean for the organization in 5-10 years time? And I don't think anybody's got an answer for that yet. And different people are taking, I think different organizations are taking different approaches of that.
Yeah, I mean, it's certainly shaking up all industries, and it's an interesting one to watch because it's developing fast as well.
I
But
think,
look,
sorry, Jake, I was going to say, sorry, I should have said, look, there's obviously the portfolio company side of things as well.
mhm,
And every sector is going to be slightly, every business is different, every sector is different, but AI will have an effect to some degree. And I would be surprised if most private equity firms weren't asking their management teams to fairly continuously assess the state of play in terms of how they benchmark against what they think is the best in class activity. And then if you're fortunate enough to have an operating partner team, I guess which we are, then having specialists who are sitting down on a regular basis with the management teams in question and thinking about the playbook and the AI related business plan and how you get the most out of it, and also be aware of what the threats might be.
mhm.
It is again is going to be something that the private equity industry is going to be heavily focused on.
Yeah, yeah. Okay, so for any listeners that might be, on the C-suite or board of a PE-backed business and preparing to exit that current investment, what advice would you give to them in 2026?
Well, don't rush into anything. Well, I think you can stratify things based on let's see, the perceived quality of the asset in question. But I think you need to be, or any seller needs to be very realistic about the perceived quality. So there are obviously genuinely A-grade assets. Those are relatively easy to sell. They won't necessarily sell in the most efficient manner for the best price unless everything is the process around selling that is well run, everything's well optimized, and probably end up with a little bit of luck as well. Luck is always quite often a feature in these things. But those aren't really the assets where there's potentially going to be a problem. For everything else, so let's call it the sort of the B plus and below, just need to be really sort of prepared. And what do I mean by prepared? Well, think about your exit timelines. Have an advisor potentially appointed a long time before you formally launch a process. Think about what the pitch is going to be to the next buyer, who that buyer might be, why your business might be attractive to that buyer group or those different buyer groups. Make sure the information is in place and easy to access to support all of that. Make sure that the management team is there to be able to articulate some of this, particularly if you're likely to be selling to a private equity buyer. If there are gaps there, try and fill them early. Also think about the nature of the process. Often there's a tendency to send information out to lots of buyers, and hopefully somebody will come out of the woodwork. Again, that can work very well with the very high quality assets. Below that, in the current market, often a more rifle shot approach where you go to a smaller group and provide a good amount of access, but that group's been more cherry picked, and they're aware they're cherry picked. They're aware it's a more limited process, so the opportunity to win is that much greater. You'll probably end up with a better result on those sort of C plus stroke B grade assets, and just be realistic on, again, come back to my first point, be realistic on the valuation, particularly through a discussion with sell side advisors. They will probably give you indications of potential value that are likely to be, let's just say, at the high end of what's achievable.
Hmm.
And the danger is you lock on to the highest number you hear, and that becomes the floor. You should probably have, any seller should probably have a view as to what their reserve price should be before they ever hear a indicative valuation idea from an advisor. And then keep coming back to that. Are you likely to be on target to achieve that number? And
Yeah.
if you are, then good result.
Yeah. Okay. Finally, Alistair, how important is it for leaders, and especially those that are, first time working in PE, to have reference points, whether it's, a mentor, someone that, in your network that's worked in PE, external reference points, in this kind of environment, and when prepping for an exit?
I think it's very important. Operating in a vacuum is rarely the best strategy. I think it's again, this is for a lot of people, particularly management teams, obviously particularly founders. This is one of the biggest decisions that you will ever make if you're selling your business, and therefore to get reference points to either help reinforce or change the view that you might have around valuation or timing or what your business really stands for, and when the story you're really going to be selling is pretty important. I think one of the biggest advantages that private equity bring, particularly private equity firms that operate across multiple different sectors, and those businesses or those private equity firms that have been operating for a long period of time, is they have a lot of reference points, and they have reference points from really unrelated industries. But that doesn't necessarily mean the problem that's been encountered in another industry and the solution that's been identified potentially for that business isn't mappable into, and the learnings aren't applicable in that other sector. So I think if you're a founder, your management team, owner manager, whatever, having the ability to try and see the world through a different set of glasses from the outside in, through those reference points is very valuable. And I think you're likely to achieve a better exit and be more realistic when you hit some speed humps, which you probably will. You're likely to be a bit more realistic if you've got external sounding boards and you've got another perspective before you launch into it.
Yeah, yeah. Certainly. Okay, I think I'll wrap it up there. Thank you, Alistair, for sharing your views, your insights on what to expect in PE over 2026. And thanks to all our listeners for tuning in. And do look out for a follow-up podcast, probably around the midpoint of the year. We're looking to build out a bit of a PE Outlook series. So at that point, we'll look at the first half of the year, how that's panned out, and then look forward to the second half. And yeah, Alistair, it'd be great to have you on again at some point. But that's all for now. Thanks again, Alistair, and bye for now.
Thank you.